So, Mike, today we're going to talk about rate hikes and forward guidance and what's happening in the market right now because we've seen an acceleration in the expected number of rate hikes. We'll talk with the viewers about how we see this unfolding, why the rate hike expectations have risen so dramatically. So we had the Fed come out and say they were looking to hike rates 3 times, and now there's a rate hike expectation of 6.5 in the market, which has driven short-term rates up considerably, and the yield curve is starting to flatten, which is never a good sign. So let's take a look at this first chart on the rate hikes expected in 2022 and tell the viewers what we see here.
Yeah, this chart here, the blue line is what the Fed funds futures market thinks in terms of rate hikes at the end of 2022. And so we actually want to start at this chart at September 2021. Back then, it was a known that inflation was running hot. Expectations were that inflation would get a 7 handle, headline CPI, as we got into early 2022. And you can see at that point, before the September Fed meeting, which happened at the end of September, the Fed funds futures market was saying maybe 1 rate hike next year. And then you can see these expectations went up and to the right, nonstop. And so that was primarily because at that September meeting, that's when the Fed started getting very hawkish. And hawkish in terms of saying we are going to do whatever we need to do in terms of increasing interest rates in order to fight inflation. And so you saw rate hike expectations start to creep up. And then once again, as we got into January 2022, we made a jump from 3 rate hikes expected to now 6.5. And so the new information there, the December meeting minutes, which were released in early January, talking about the Fed not only doing whatever they need to do in terms of interest rate hikes to fight inflation, but also reducing the size of their balance sheet, quantitative tightening. That was new news for the market. That and then the January Fed meeting, once again, the Fed talking very hawkishly. And now here we are, 6.5 rate hikes. There are 7 meetings left in the year. So this is almost 125 basis point rate hike per meeting for the rest of the year.
And so why does the market front run these rate hikes? And number one, and number two, why are they almost double what the Fed has essentially announced? Like, what is the market saying versus what the Fed has said?
Yeah, so the Fed is using a policy tool here very effectively. The Fed has 3 primary policy tools. The first is interest rate hikes. The second would be the size of their balance sheet. And the third is forward guidance. And forward guidance just means their words. So the Fed can talk a big game about rate hikes, speak very hawkishly, say certain things in press conferences. There are a number of opportunities for them to drop little breadcrumbs for the market to pick up on, and the market can run with them. And the market forward guidance in this instance has been very effective. The market has run with this hawkish language and has basically already started tightening financial conditions for the Fed.
So to relate that in terms of the market raising rates so quickly and so aggressively, is that concerns over inflation or what is driving those hikes?
The primary change in the market's expectations for the Fed is viewing the Fed's policy response. Everybody knew late last year that inflation was going to run hot, might peak during Q1 2022. Everybody knew that inflation had been beating expectations. The news is not playing the cards because we kind of knew these cards were going to be dealt. It's playing the player. And so the market is running with the Fed's policy response, saying they are going to meet this inflation with very aggressive rate hikes because they're worried they're offsides and they're worried we might already be in a wage price spiral.
So let's pull up the next chart and look at the forecasts for the balance sheet and the Fed funds rate and explain what we're projecting out here or what the Fed has projected out here.
Yeah, this is effectively what the Fed has talked the market into believing over the next 2 years. So the Fed using its third policy tool, forward guidance, to impact expectations for their first 2 policy tools, interest rate hikes in blue and the size of the balance sheet in green. The Fed funds rate over the next 2 years, that blue line, the market now expects the Fed to pretty steadily increase the federal funds rate up to a little over 2% by the end of 2023. And then the green line, so now the consensus is that the Fed will wrap up the taper, so stop increasing the size of their balance sheet in March, maintain the size of their balance sheet for about 2 months, 3 months, and then back half of this year start reducing the size of their balance sheet by a pace of up to $100 billion per month. And so that's almost a $2 trillion reduction in the size of the balance sheet over the course of the next almost 2 years. So that is now what the market believes. And so the market thinks, well, if this happens, well, there are a number of other adjustments that need to be made within financial markets to account for this path. And so that's also what we're seeing.
Okay. And let's look at the actual impact on short-term yields. We've seen them skyrocket from basically, 0 to almost 1.6% in a record time here. So the reaction that this has caused in the flattening of the yield curve, how is this sort of playing out?
Yeah, so there have been a lot of headlines. The Fed has lost credibility. Well, this chart clearly shows they have not. The market is taking them very seriously. So this purple line is the yield on the 2-year Treasury note. And you can see it has taken off from about 0.3% up to 1.56% without the Fed hiking interest rates at all. So this is the market selling off short-term bond yields, raising other short-term interest rates that the market has control of because of what they now expect from the Fed. So this is what we talk about forward guidance being a policy tool that the Fed is using very well, and the market is already hiking interest rates for them. Obviously, the market can't hike the Fed funds rate, but the market can hike other rates, and those other rates are being hiked.
And this has led to losses on the short end of the curve in the fixed income space. So as equity markets have also sold off, you've seen fixed income not responding the way it typically does because of this. Bigger impact we've seen or hear from our clients is the impact on mortgage rates, because something similar is happening there. So let's walk through what's happened in mortgage rates and how will this impact demand for housing or refinancing?
Yeah. Looking at mortgage rates, that green line, you see that huge jump once again, and that entire jump from about 3% to a little over 4%. So a 1% jump in 30-year fixed national average mortgage rates. That has come without the Fed actually doing anything, just talking, just forward guidance. And so you're seeing this big jump for 2 reasons. 1, expectations are the Fed's going to hike interest rates. 2, the Fed is also going to reduce the size of their balance sheet, and that involves mortgage-backed securities. So the market for mortgage-backed securities is probably going to get a little more illiquid, a little difficult to sell into. And so lenders are raising mortgage rates to compensate for that. So sort of the double whammy. And this is where you see, why you take a step back. Why does the Fed want to hike interest rates? Why do they want to reduce the size of their balance sheet? Well, to get inflation down. How do they get inflation down? These things do nothing to solve supply chain issues. They can only decrease demand. That's it. They can only slow economic growth. And this is happening already. There's something called expectations theory when it comes to consumption. What a lot of potential home buyers are doing, looking at this chart, is they're rushing out right now to get a mortgage and buy a home because they think, hey, I got to get in before the going gets really tough. And yeah, mortgage rates are at 4% now, but that's tolerable. I can't do this if they're at 5.5. I want to get at least a decent deal. Mm-hmm. So what you get is future purchases pulled into the present. You front load demand. And that effectively shortens the economic cycle. Some people who said, maybe I'll buy a house at the end of the year, well, they're going to buy it right now. And that means at the end of the year, you're going to have a sharper slowdown in growth. So this is forward guidance working. This is the market doing the tightening for the Fed.
Yeah, I mean, we could debate whether it's, what working means. I mean, as tightening into a slowdown can be very detrimental. So you mentioned expectations. So on the next chart, expectations for inflation are starting to come down.
Exactly. Yeah. Another sign showing that the market is running with this forward guidance. So these are 5-year forward break-even inflation numbers, which involves futures markets, but it's basically looking out into the bond market and saying, what does the collective wisdom of the bond market think inflation will run at over the next 5 years? This is one of the most commonly watched inflation expectation metrics within the bond market. And you can see we topped out at about 2.5%, so that's a little hot. And now we're right around 2%. So this is the market giving the Fed feedback. Hey, if you hike like this, like we think you're going to hike, and you run off the balance sheet, you're going to achieve your inflation target. But that might happen because you put us in recession. So it's a bit like cutting off your nose to spite your face. If you gave a lot of people the trade-off between 2.5% inflation versus an economic recession, I'll bet a lot would go with the 2.5% inflation. Mm-hmm. And this also speaks to why every single time the Fed hikes like this, they end up overdoing it, and they end up inverting the curve, and they end up putting you into a recession. And go ahead.
We're not calling for a recession yet, but let's take a look at the next chart, because we are on that road, and we're approaching that point where the curve could invert. We're as close as we've been in a while.
Yeah, we're not calling for a recession yet. The bond market isn't calling for a recession yet. This chart, it's the difference between the 10-year yield and the 2-year yield. And we call it the smartest economist in the room, because when it inverts, when it goes negative, meaning the 2-year yield is higher than the 10-year yield, that has preceded every economic recession since World War II, with a lead of anywhere from 12 to 24 months. And we are on the path. I mean, the spread here is only 39 basis points. And if you look out to the futures market, the forwards, the swap market, the bond market is saying 1 year out, this actually is inverted. So if you look at what I think the 10-year yield is going to be at a year from now, and what I think the 2-year yield is going to be at a year from now, that spread is inverted. So that's sort of the first sign. So market giving the Fed a lot of feedback. We believe you. We're hiking interest rates for you. If you continue down this path, we do think there is a high probability of recession, but you will get inflation in line with expectations. And, then we can debate the bull and the base case from here, because it does create a potential bull case for the Fed as well.
Yeah. So let's talk about, we talk about forward guidance as a policy tool, and how the Fed uses that is really, you tell me, but in my opinion, it is generally a function of who the Fed chair is and how they manage the committee. And everyone's going to use it different, although there is some similarities into how they think about it. But in terms of forward guidance and pivoting, that can have a major impact on whether we do go into recession, or we have a bounce off and reaccelerate. So just talk a little bit about forward guidance and how Powell could potentially manage through the big delta of 6.5 rate hikes versus 3, and really pushing us into recession.
Yeah, forward guidance has been used. It probably was used most significantly by Ben Bernanke during the global financial crisis, and wasn't formally recognized as a policy tool by the Fed until 2020. And so one way, everything we've just talked about, one way you could look at how effectively the Fed's using forward guidance is, you say, well, if you bark loud enough, you won't have to bite as hard later. So the market's doing their hiking for them right now. The market is tightening financial conditions, potentially reducing the demand and growth outlook, and reducing inflation expectations. Great, thanks. Now I don't have to hike interest rates as much. So if you have credibility, if the market believes you and you bark loud enough, then you probably won't have to lean as heavy on your other policy tools, raising interest rates and reducing the size of the balance sheet. However, you do still have to use them, because if you don't use them, then you lose all credibility, right? So this totally changes the narrative. You think about the Fed last year, clearly offsides, right? Still buying $120 billion in assets, emergency policy tools, interest rates at 0, even though inflation's running well above 5%. It's in their best interest to bark as loudly as possible, right? This year, the market has already sort of run with their words. All they have to do technically is do the absolute minimum in terms of rate hikes and balance sheet reduction to maintain credibility. If they come out and don't hike at all, well, forward guidance is not going to be an effective tool in the future.
Right.
Nobody's going to believe their words, right?
Right.
So they need to maintain that level of credibility.
Right.
But the good news is they probably have to do as much.
Yeah. And what are the things we're watching to anticipate when the potential pivot would be happening?
The big thing is looking at when the economic growth momentum starts to slow, inflation actually starts to come down, market starts to price in some nasty stuff. A lot of this is already happening, right? You look out into the futures market, you say, is the curve inverted? Eventually, these things will pile up to the point where, the market stops pricing in more rate hikes. And then they say, all right, you're good. Just do this and we'll be done. And then what happened during the last hike cycle is the market starts to price in rate cuts. That didn't happen until after the 2s, 10s yield curve actually inverted. That was in spring of 2019. Mm-hmm. And the market started to price in cuts, and the Fed followed with cuts. So bad stuff happens. It's already sort of starting to happen. Then the market gets comfortable with what the Fed can deliver. Then the market says you've probably done a little too much. And as long as the Fed listens to that, you could negotiate a pivot and a soft landing.
Mm-hmm. So in terms of over-under, we're taking the under on the 6.5?
Under on the 6.5 seems somewhat reasonable, but once again, we think in probabilities and scenarios. And if the Fed hikes at every meeting, that's the scenario. The probability of that scenario is rising, and we will adjust accordingly. At this point, they haven't done anything yet, and the market's doing their work for them.
Great. Well, that's a good primer on the forward policy guidance and what's going on in the current markets.